Insurance compensation. Again, before I take you to this, let's understand what I'm trying to convey in this particular slide. Now, let's say, for example, we had a company, okay, and the company was owning two things. One, plant and machinery, and second, some raw material, right? Now, what happened was that on one of the bad days, there was fire all around. Okay. And both these plant and machinery and the raw material were damaged. Right? Thankfully, the company, what it did was, it did an insurance of both the plant and machinery and the raw material. Okay. Well, let's say there were two situations. One, the company did an insurance, okay, and the second was there was no insurance, right? What this section deals with is that whenever there is a damage or a destruction of a capital asset. Now we know that plant and machinery is a capital asset, right? While raw material is what? It's a trading asset, right? Raw material is not a trading capital asset that we saw when we saw the definition of a capital asset. So what will be the tax treatment when you receive some money, okay, from the insurance company on account of damage or destruction of a capital asset? Let's now see the language. Profits earned on receipt of insurance compensation. So what is happening here is you are getting insurance compensation. So taxation will happen only when there are any profits. Okay. So let's say the insurance company gives you 500 and your cost of acquisition is only 400. So there's a profit of 100. So profits earned on receipt of insurance compensation on account of damage to or destruction of any capital asset. Again, just like I said, it's only on the destruction of a capital asset that this section is applicable. If raw material is destroyed, it is not a capital asset, and therefore any compensation received there will be a business income or a trading income. It will not be taxable under the head capital gains. Attributable to the following reasons shall be taxable under the head capital gains for the previous year in which such money or other asset was received. Two things which you need to note here is that one, the damage has to be because of one of these four reasons, right? And the second is that the taxation is not in the year when the damage happens. The taxation is in the previous year in which such sum of money or other assets was received. So let's say if the destruction happens in financial year 10-11 and you receive the money in 11-12, the taxation is going to happen in 11-12 and not the year when the destruction happened. And what are the reasons because of which destruction should happen? It could be riot or civil disturbance, flood, typhoon, hurricane, cyclone, earthquake or other convulsion of nature, accidental fire or explosion, action by an enemy or action taken in combating an enemy, whether with or without declaration of war. So each of these items are self-explanatory, so I'm not getting into what each of them means, right? But two things important. One, there has to be profit. Two, the asset should be destroyed, and the asset which is destroyed should be a capital asset. For the reasons which are enumerated here, either 1 to 4, and then the taxation will happen in the year when you receive the money or other assets, and not in the year of destruction. Now, what will be the sale consideration? The sale consideration for the purpose of this capital gain computation will be the sum received in cash, or in other words, the money that you receive, or fair market value of the assets were received in kind. So if the insurance company comes and gives you a plant and machinery, okay, then the fair market value of the plant and machinery on the date of receipt will be considered as sale consideration, or in case you get the money, in any case you have quantified what is the amount that you are receiving, shall be the full value of consideration. Now, the last thing is what happens if the destruction happens? Okay, let me go back. The second thing was there is no insurance. Okay, so basically your asset is destroyed, there is no insurance, you don't get any compensation. In that case, this loss will be a capital loss. Asset destruction would be a capital loss which does not have a tax treatment. So you will not get any depreciation or anything on the value of this asset, right? This will be a capital loss which does not have any tax treatment. I hope this point is clear to you. We'll now move on to the next slide.